Do you want to know the secret to making the most money with compound interest? Well, let's take a little journey into the world of finance. You see, compound interest is like a magic potion to your savings. It's a fundamental principle of investing and saving that works by earning interest, not just on your initial investment, but also on the interest that has been added to it. Imagine you're planting a seed. This seed represents your initial investment, the money you put away. Now, as time passes, this seed sprouts and grows into a tree. This growth represents the interest you're earning. But here's the magic part. The tree doesn't just grow upwards, it also grows outwards, sprouting new branches and leaves. These new parts represent the additional interest you earn on your initial interest. This is compound interest in action. Compound interest is often referred to as interest on interest. It's the snowball effect that can help your savings or investments grow faster over time. The more frequently interest is added to your total, the faster your investment grows. Now, why is this important, you might ask? Well, compound interest can significantly increase the amount of money you end up with. It's like a powerful engine that can propel your savings or investments forward, helping you move closer to your financial goals, whether it's buying a house, starting a business, or retiring comfortably. The beauty of compound interest is that anyone can take advantage of it. Whether you're a seasoned investor or a beginner saver, understanding and using compound interest can be a game changer for your financial future. And the best part, you don't need a huge amount of money to start benefiting from compound interest. Even small regular investments can snowball over time, thanks to the magic of compounding. So, are you ready to harness the power of compound interest and make your money work harder for you? Now, let's dive into the 5 investing tips that will help you make the most of compound interest. The first tip is to start early. Now, this isn't just a casual suggestion, it's a game-changing strategy. Why, you ask? Well, it's all because of a little magical thing called compound interest. Imagine you're planting a tree. If you plant it today and care for it over the years, it'll grow bigger, stronger, and bear more fruit. But if you wait for, let's say, 10 years to plant it, you'll have missed out on all that growth and bounty. Investing early works in a similar fashion. The sooner you start, the more time your money has to grow. Let's break it down with a plain and simple example. Say you start investing $100 a month at the age of 25. Assuming a 7% annual return, by the time you hit 65, you would have around $264,000. Not bad, right? But now, let's say you waited and started investing the same amount at 35. With the same return rate by 65, you'd only have around $122,000. That's less than half of what you could have had if you started 10 years earlier. That's the power of compound interest. It's not just your initial investment that earns interest, but also the interest you've already accrued. Over time, this creates a snowball effect where your wealth starts to grow at an increasingly rapid pace. The positive impact of starting early cannot be overstated. It's like giving your future self a gift of financial security and peace of mind, which, let's be honest, is priceless. But remember, starting early doesn't mean you have to have a lot of money to invest. Even small amounts can grow significantly over time. The key is to make a start, however small it may be. So here's the takeaway. Don't wait for the perfect time to start your investment journey, because the perfect time is now. Remember, time is money when it comes to compound interest. And the more time you give your money to work for you, the more it'll reward you in the future. Don't delay. Start your investment journey today. Tip number 2 is to invest consistently. It's like maintaining a garden. You can't just plant a seed, water it once, and expect a tree to grow overnight. The same principle applies to investing. It's not about making a single large investment and then resting on your laurels, hoping for a jackpot. Instead, imagine a steady stream of water nurturing your garden, feeding your plants little by little. This consistent approach to investing, where you regularly contribute to your investments regardless of market highs or lows, is what fuels the power of compound interest. Each investment you make is like a new seed. Over time, these seeds grow, and their growth in turn fuels further growth. This is the essence of compounding. The more seeds you plant, and the more consistently you water them, the more bountiful your harvest. And remember, the market will have its ups and downs, but in the long run, it's consistency that counts. Consistency is key in the world of compound interest. Our third tip is to reinvest your earnings. Now, you might be wondering, what does that mean? Well, it's pretty simple. When you earn dividends or interest from your investments, instead of pocketing the cash, you put it back into your investment. This is what we call reinvesting your earnings. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and larger. This is the same concept. Your investment is the snowball, and the snow it's picking up, that's the interest or dividends you're reinvesting. By doing this, you're increasing the size of your investment, which means you're also increasing the potential returns you can earn. Let's put this into perspective. Say you invest $1,000 and earn a 10% return annually, but you decide to take your $100 profit each year. After 10 years, you'd still only have your original $1,000, plus $1,000 in profits. That's $2,000 in total. But if you had reinvested those earnings, after 10 years you wouldn't have $2,000, you'd have nearly $3,600. That's the power of reinvestment. So next time you receive dividends or interest, think twice before spending it. Remember, every dollar you reinvest is a dollar that's working for you, earning you more money. Reinvestment can significantly boost your compound interest game. Tip 4 is about diversifying your investments. Now, you might wonder, what's diversification? It's essentially not putting all your eggs in one basket. It's spreading your investments across different asset classes like stocks, bonds, real estate, and even commodities. Why do we diversify though? Well, diversification helps to manage risk. Each investment has its own set of risks and rewards. By spreading out your investments, you're not relying on one single source for your returns. If one investment takes a hit, the others may still perform well, balancing out your losses. Now, how does this tie into compound interest? Here's the thing. Compound interest thrives on time. The longer your money is invested, the more time it has to grow. But if you're heavily invested in one area that suffers a major downturn, you could lose a significant amount of your investment. That's a setback on your compound interest journey. Diversifying your investments can help mitigate this risk. Even if one part of your portfolio takes a hit, the rest can continue to earn and compound. It's like having a team of runners in a relay race. If one stumbles, the others can still carry on and finish the race. But remember, diversification doesn't guarantee profits or protect against all losses. It's a strategy to spread risk and potentially enhance long-term returns. So, be smart, do your research, and consider a diversified approach to your investments. Diversification provides a safety net for your compound interest journey. Our final tip is to be patient. In the world of compound interest, patience isn't just a virtue, it's an essential ingredient. You see, the magic of compound interest doesn't happen overnight. It's a long-term investment strategy that requires a consistent and steady approach. Now, we live in a world that's all about instant gratification. We want things here and now, and the same can be said about our expectations when it comes to investments. We often find ourselves drawn to the allure of get-rich-quick schemes. But let me tell you, these can often lead to poor investment decisions. Why is that, you ask? Well, these schemes are usually high-risk ventures that can result in significant losses. And while they may offer the possibility of quick returns, they can also leave you with nothing to show for your hard-earned money. On the other hand, compound interest works differently. It's like a snowball rolling down a hill. At first, the growth may seem slow, almost insignificant. But as time passes, the snowball grows larger, picking up more snow with every roll. That's how compound interest works. Your money grows, not just from your initial investment, but also from the interest it earns over time. So, if you're looking to make the most money with compound interest, you need to be patient. You need to resist the urge to withdraw your money at the first sign of profit. Remember, it's not about getting rich quick, it's about building wealth over time. And let's not forget, patience can also help you weather the ups and downs of the market. Instead of panicking and making rash decisions during market downturns, a patient investor understands that these fluctuations are part of the journey. They know that with time, the market will recover and their investment will continue to grow. In conclusion, to truly make the most of compound interest, you need to embrace the art of patience. It's about understanding that good things take time. It's about knowing that the path to financial freedom isn't a sprint, it's a marathon. Patience truly is a virtue when it comes to compound interest. So those are our 5 investing tips to make the most of compound interest. Start early and keep investing consistently. Remember to reinvest your earnings and diversify your portfolio. Patience indeed is a virtue in the world of compound interest. The power of time and regular savings can work wonders for your future wealth. If you found this video helpful, don't forget to like, share, and subscribe for more investment tips. Remember, your future wealth is in your hands.